Since 2002, a $10,000 investment in Amazon has turned into $2 million. A $10,000 investment in Nvidia has turned into $456,000. But both stocks have lost more than 50% of their value multiple times over that 20-year time horizon. Today, we're going to jump into the lessons learned from those stocks and those returns, that time frame of 20 years, and what investors today can take away from those lessons. I'm also going to share my portfolio and show you just how bad I'm down and the stocks that I own in case anybody wants that accountability and to see, what I actually own and what I'm doing at the end of the video. And first up, we have the graphs of Amazon and Nvidia since 2002. You can see purple here is Amazon, orange is Nvidia. This shows $10,000 invested that entire time period, gets you to $2 million in Amazon and $456,000 in Nvidia. But let's look at percent off highs. So right now, Amazon is 41% off its all-time high, and Nvidia is 49%. But if we look back over this time period, look at how many times Nvidia has dropped 80% in value. One time, that was in 2002. Then another time, it looks like back in 2004, during the Great Financial Crisis in 2008, and almost again in 2010. And now we're sitting at down almost 50%. So Amazon, same deal, hasn't dropped 80% over this time frame. It did in 1999 to 2000, 2002. But Amazon, even as a larger company over that time period, has dropped 40%, at least 3, maybe 5 times. And so the lesson there is that great companies can be super volatile. This is showing what happened in the price of Amazon from 2003 to 2006. The price to sales ratio, that's a metric that businesses that aren't quite profitable are often valued off of, price to sales. A lot of software stocks today are valued that way. The price to sales ratio went from about 5 in 2003 to about 1 in 2006. The sales grew, so it wasn't as bad of a loss as that sounds like if you do the math, but it was still a 56% loss. And so today we've seen stocks that have dropped that much. And there's a lot of people out there saying how much of a percent it needs to get back before investors ever get back to even. And so now if we look at Amazon from that time period, that high heading into that 54% loss, we could see here how long it took investors to get back to even. And we could see just by this line that it took investors to about 2007 to get back to even from that previous high. Through 2007, it was only up about 10%. But then again, during the Great Financial Crisis, it dropped back down. And so it didn't get back above its high and stay there until 2009. So lesson number 1 is that if you're a growth investor, periods of 5 years of negative to no returns are certainly a possibility. And that's why I invest with a mindset of not investing money and I've said this time and time again on this channel, and you can go back and look at the videos, never invest money that you might need in the next 3 to 5 years. Investing for me is a process, it's a journey. And I've committed, as David Gardner, co-founder of The Motley Fool, talks about, to being a lifelong investor. So we've zoomed out and now we're looking at 2002 to 2013. And so even after that crazy loss down to, $1.89 in 2008, if you were invested for 10 years from 2002 to 2012, 2013, your investment was then worth 490% more, or 20% per year, turning $10,000 into $59,000. At that point, Amazon was already a large company. Now if we extend it another about 10 years and we go from, we're looking at 2004 now, from a price sales ratio of 4 to 2019, a price to sales ratio of 3. Amazon, for the investor that was able to hold for 15 years, has now returned 3,362%, turning $10,000 into $346,000 for an annualized return of 25%. That is how life-changing returns are made in the stock market. Finding the right companies, being conservative and not taking on margin, having your personal side, your income, your savings in order so that you're not investing money that you might need in the next 3 to 5 years, and you can withstand this negativity and invest in great businesses. Owning companies that, as you can see, their revenue per share during all these ups and downs continued to grow at a pretty strong rate, between 20 and 30% per year. And for the investor that was able to see through the short-termism, see through the negativity, all of the negative headlines in those years, and stay invested or add over time as they continue to follow the business, see the good results, and believe in the company, but keeping it a responsible size of their portfolio that they're willing to handle the volatility, life-changing returns. So let's run through the same thing pretty quickly with Nvidia, right? From 2002 to 2004, Nvidia on a sales multiple, so this is price to sales, went from a price to sales ratio of 8 down to a price to sales ratio of under 1. That was an 85% loss in 2.5 years for investors. Many probably felt like they would never recover. Many probably sold at the bottom, during peak fear, or they were overexposed or leveraged or whatever. It took until 2006 just to get back to even from that drop after 2002. But then it dropped again after the great financial crisis down to 458. So still you're looking at a negative return. And then into 2009 or into the end of 2008, it dropped back down to $1.60. Imagine that ride, imagine that volatility, imagine how fearful and painful that was. And the truth is, a lot of investors that lost their jobs or their homes or whatever in this period may have had to sell. They may have had to stop investing. And so that's why for individual investors, do-it-yourself investors, retail investors, whatever we want to call ourselves, it's important to have, investing is just part of the plan, right? And things on the personal savings side and employment side and income side, expense side, have to be squared away to be able to stay invested. But for the investor that's been invested since 2002 for 20 years now and been through those ups and downs, they've averaged 18% a year compared to the S&P 500, and that's turned $10,000 into $317,000 before dividends. They've started paying a dividend, so $319,000 over that time period. The lesson to me is clear. Finding the right companies is part of the process, but having our structure and our process in place to invest responsibly, just $10,000 in those companies or $5,000 in either of those companies would have been life-changing. And so whatever that amount is for you, that's an appropriate part of your portfolio, having that invested in the right companies and then having your investments be part of your overall financial strategy and the rest of it responsible and squared away so that you can stay invested during these time frames is so important for individual investors. And then tuning out the noise and the craziness and people telling you you're dumb for investing in these crazy high growth stocks that have dropped so much and you'll never make your money back. Well, if you're invested in the right companies and you have the right structure in place and you buy over time, imagine if somebody was buying Nvidia over this time, because keeping it as a percentage of their portfolio that they were comfortable with. Maybe it was 3%, maybe it was 5%. Their returns are even better and more life-changing. And so that's my takeaway. That's my message in these markets, is that volatility happens. Investing for us is about more than just what's invested in the stock price. Keeping that long-term mindset, not trying to get rich overnight, which keeps us out of that fear of missing out and keeps us looking for great businesses and understanding that owning the right businesses can do just fine for us over time. Promised I would share the portfolio at the end of the video. Full transparency, we have put $67,000 in. Portfolio is currently worth about $50,000, so we're down $17,000. On the day, I'd imagine it's pretty bad. Yep, we're down 7.6%. Here are the stocks that I own. Crazy growth stocks that a lot of people don't want to own. Take a screenshot if you want to see what I own. These are the types of stocks I talk about a lot in these videos, but I'm also going to cover other types of investments like dividend stocks and different things, just to show the different, even ETFs and index funds, just to show the different potential out there. But obviously I'm going to cover a lot of my own stocks. If you like this content, if you want to support this video, it helps me out if you like it. That helps me know what types of videos to make and helps other people find it. And then if you subscribe and leave a comment on the video, that helps it rank in YouTube's algorithm. If you leave a comment of a company you want me to cover, I will do an analysis of the company at a high level using fast graphs. So just let me know and leave that in the comments. Thanks for watching. Take care of yourselves and your family and stay positive. There's a lot of negativity out there. Stay positive. It's a superpower to stay positive.